Join this session as retail expert Jonathan de Mello walk us through key market insight into the current retail landscape. Please welcome Jonathan.
Few technical issues. Hopefully that's okay. Can everyone hear me? Oh, great. Fantastic. There's an echo now. That's perfect. So I'm going to just walk you through basically what's going on in the retail market as of now and also into the future, our projections as to what's going to happen down the line, really, given we're in the midst of the cost of living crisis. Some retailers are struggling. A lot of them actually did quite well over Christmas, as we're going to come on to see. What we've found over the course of the last, I guess, few years since COVID is that some retailers have fallen by the wayside, like Debenhams, Arcadia, and quite a few others actually as well. But we've seen a sort of survival of the fittest, a bit of an accretion towards the likes of Frasers Group, the likes of Next, as they buy more and more brands. So we're going to sort of talk through that and hopefully give you an insight as to kind of what the future will look like as well. I'm going to move forwards. Just in terms of background to kind of what our business is as well, just for any of you that don't know, we basically provide consulting work to property investors, private equity firms, retailers that are looking to expand internationally, expand within their own geography, and also just help them to understand better kind of what their P&L outcome might be in the future. So it's kind of financial modeling, but also aiding retailers with expansion. And we've got clients like Estee Lauder companies, PVH Corp that have Hugo Boss, Tommy Hilfiger and others, and quite a few other sort of fashion brands. So I know some of you are kind of from the fashion sector, some from the home sector, and we cover lots of markets. So that's just a bit of a background to us. I'm often asked to talk about the retail market to sort of venues like this, but also to the press. So often get asked kind of what's going on with JD Sports, H&M, and all sorts of other brands. So hopefully can give you some insight today into kind of some of these brands. And I'm going to leave some time for Q&A as well at the end. And also, if you want to, you can stop me and ask questions of clarification as I go through all of this as well. So the first slide is actually kind of an overview, really, that we've put together on Christmas trading. I know some of it's going to be hard for you to read at the back, but what you can see on the left is retailers that did well from a like-for-like perspective over the course of Christmas 2022. And the thing is with retailers, they report whatever they feel like, so they report what makes them look good, typically. So they're all very, very much different reporting periods. It could be November to early January. It could be October to December. It's up to the retailer as to how they want to report this. They're not sort of obligated to report this, versus, say, their annual financial or quarterly results. So as you can see on the left, or actually the colors, first of all, to dwell on, you can see online retailers, which are highlighted in sort of an orange color there. They're the pure plays. So the likes of ASOS on the right, Boohoo, N Brown, online-only retailers that basically have not done particularly well over the Christmas periods. And the reason for that is that it's a number of reasons, but one of them is the strikes we saw by the Royal Mail over the Christmas period. So it led to basically people losing faith to a certain extent in online retail. And they substituted that online retail with physical retail, going into physical stores. So you can see on the left, the principal set of retailers there on the left is retailers with physical stores, physical estates. You can see some different retailers there like Primark, M&S, Next, all posting very good results. Now, a lot of this needs to be taken with a pinch of salt because inflation is a big driver of this level of growth. This is value growth, not volume growth. Underlying volumes in retail were actually down over the course of, I guess, the second half of 2022, for most at least. But you can see on the left that some retailers actually beat that. So on the grocery front, you can see Aldi and Lidl highlighted green. And those are two that actually had inflation-busting growth, if you like. We're talking about 22, 23% growth levels, like for like, over the course of the previous year. And that's, if you contextualize that with grocery inflation, that was up at about 14% during the same period. So they were the only grocers that actually grew from a volume perspective. But you can see on the right, whilst Tesco, Sainsbury's, Asda, Morrison's, they all grew to a point from a value perspective, their volumes were actually significantly down because of grocery inflation. So always, when you look at the sort of news headlines and you see, oh, great results, it is good, and it's much better than a lot of the analysts expected, but it's still not as great as perhaps the press suggested, let's say. But some standouts, Primark continue to dominate the fashion sector and grow and grow. They're going internationally, they're going within the UK, they're taking bigger, better stores, and they are a phenomenon, really. I was actually asked by The Times today about Reserved. I don't know if you know that sort of Central and Eastern European fashion retailer. They're looking to expand across the UK. They're going to take another store on Oxford Street. They're going to take Trafford Centre, the Westfield London and Stratford Centres too. So they're really pushing hard on expansion. But my view on them is that they need to build brand equity if they want to survive in the UK, because we have so many strong incumbents. Obviously Primark, H&M, Zara, Next, even M&S, they really push hard on their fashion, and they're growing their fashion sector right now. So I guess Reserved, they're going to struggle to an extent to build that brand equity quickly and also differentiate themselves against the competition that we have here. The reason that they're looking to expand in the UK is because their principal markets are Russia, Ukraine, and obviously markets that have been hit very hard by the recent problems we've seen there. But yeah, from a fashion perspective, highlighted in dark blue, you can see a lot of the high street fashion retailers that have physical stores did pretty well actually over Christmas as people went back to physical stores. And on the right, you see ASOS and Boohoo, as I said before, and they are really struggling. They're now in positions well, they're bleeding cash. They have high inventories. I know ASOS had to write off £1 billion worth of debt, or inventory at least, which is significant. And so my view is that one of these, maybe not those two, but one big online fashion pure play will fall in the next year and a half or so, given stock levels, given order levels are dropping. And also, Boohoo have now started to charge for online returns, which is a big deal because a lot of people that order online buy, let's say, 4 or 5 products, return most of them and keep a couple, that fit them properly. So I see, unfortunately, one of these big online pure plays struggling and potentially going under. We may or may not see that. It's a prediction. Let's see. But as you can see, in general, the picture for retail was decent over the Christmas periods. The question is whether that's going to be maintained now, because 2022 was very much a year of 2 halves, and I think 2023 will be as well, in the sense that in the first half of 2022, we didn't see that much in the way of inflation. It only started to sort of pervade itself into the UK markets in the second half of 2022. And the prognosis for 2023 is that the second half of this year, inflation will fall back, given fuel costs are dropping again, freight costs are dropping. So we should start to see a better picture for retail in the second half of 2023. However, this particular half of the year will be problematic, let's say, for a lot of retailers. There's some positives, though, in that, including business rates, which I'm going to come on to. So this is, I don't know if you're familiar with this Barclaycard data, and what I did is I expanded the text as much as I could so that you can see better. So hopefully you can all see the numbers at least here. And this is Barclaycard's consumer spending by retail category, and it's going back to May 2022, so it's quite detailed actually. So you can see the May to December period. And what you can see, I guess the red colors are where we've seen like-for-like decline over the course of the previous year. And the green colors are where we've seen positive growth. So overall, from a retail perspective, you can see that retail has grown, but you've got to contextualize that again with inflation, which for some of these months was up at 10%. So from a volume perspective, transactions have fallen. And if you look at it category by category, you can see in fashion that we have now seen sort of not just volume decline, but also value decline in the case of August, September, October, and November, with a slight boost in December, which obviously sort of links with those results I showed you before. But this is all retail, not just the retailers that we sort of showed on that chart. And if you go down, you can see furniture, household goods, DIY, home improvements. A lot of those retailers, unfortunately, they were in a situation where they did extremely well during COVID because people were looking to invest in their homes, their home offices, their gardens, as they were stuck at home. So they spent or substituted a lot of their spend that they'd normally spend going out and socializing and everything else with this sort of product. But these product purchases are they're expensive for a start, and you don't tend to sort of substitute them very often as well. So once you bought your new laptop, your new tumble dryer, whatever it is, you're not going to replace it, unless you have lots of money, within a year or 2 years. So the issue is, a lot of people brought forward their purchases in these different categories, and now we saw a significant decline in electronics, furniture, and DIY, as you can see. That may start to come back, but that did for Made.com, because Made.com, the problem with them is that they over-ordered. They thought, well, things are going to just go like this, from COVID onwards. But the problem is they didn't. People had invested in their home offices, and then they were in a situation where they didn't need to anymore. And so Made basically went from just-in-time production to just-in-case, essentially holding product in warehouses, and they had significant sort of existing costs on that basis. Because when you hold inventory in warehouses, the problem is that you're paying for the rental of those warehouses unless they're your own. And then all the costs of warehouses went up, logistics, paying staff within the warehouses, etc. So they went from a really positive position, actually, to decline within the space of a few months because of that change in their strategy. It was just a bad call on their part, and Next, bought them for nothing, and now Next will benefit from that, as they have from other brands they bought for nothing as well. So we're starting to see that consolidation in the sector. So moving on to the next page, more positively, there's lots of greens on this one. As you can see, travel, people decided after COVID that they wanted to go and enjoy their holidays, and they'd not been on holiday much during the COVID period. Clearly, they couldn't. They could do staycations, but a lot of this is international travel. And I've seen some numbers from some travel agents like TUI, Virgin Holidays. In shopping malls, they're doing tens of millions of pounds from one small 1,500 square foot travel agent. It's ridiculous. They're the biggest growers as such in terms of sales, from these individual travel agent shops. So you can see there some stellar numbers from the travel agents, the airlines, etc. We saw big spikes in Netflix and Amazon Prime and digital content and subscriptions over the course of COVID, where people wanted to enjoy, box sets and staying at home, and enjoy that side of things. But that's fallen back since, as you can see. It's sort of fluctuating around the 0% mark now. Fuel costs have risen, but that's obviously because of inflation. As you can see, again, a mixed picture there. Eating and drinking is one to bear in mind, so people have, and there was a big spike in eating and drinking, and going out in general, socializing post-COVID, but that's dropped back a bit. And what you can see is restaurants actually declining over the course of the months leading up to December, around 11, 12% declines, as people started to substitute going out to restaurants because of the rising cost of doing it. We're seeing like a hamburger go from, let's say, £15 in a pub to £20, as a cost. That's significant. So people were then deciding to eat at home via takeaways, as you can see, and also, actually buying more premium products from supermarkets and substituting going out with actually eating at home with their family and friends and whatever. So you can see those numbers playing out there in the Barclaycard data. So these two graphs are a bit boring, obviously, but I can sort of explain them in a bit more detail. So on the left is inflation, basically, and if you focus just on CPI, you can see that CPI obviously went north of 10% in the latter part of 2022, and that will be maintained and actually probably exceeded in the next couple of months. But on the right, what you can see is a more positive picture, clearly, because these are the input costs into inflation on the right. So you can see different colors there. The green color is food. Obviously, we've seen big increases in the price of olive oil, sugar, in clothing, cotton prices, and everything else, all this going up. Fuel costs as well are part of that. But what you can see here is the projection going forwards. This isn't our projection, it's from the OBR. But the OBR is saying that inflation will, by Q3 2024, drop back significantly to a point where we are in a deflationary period. And you can see the black line there, which is CPI, essentially harmonized from all those different inputs. And what you can see is a decline in inflation to the point where it's deflationary. And in fashion in particular as well, you can see. So it's quite positive in a sense, but obviously we're going to face significant pain to get there of further inflation until the second half of this year. So the graph is sort of illustrating that, really. So I'm not sure if you're familiar with these forecasts, but they're pertinent because obviously if you're involved in retail and pricing and looking at kind of, how you make margins, and, often with inflation rising over a long-term period, as it has been, it means that you constantly have to change your prices, in store, and constantly replenish stock, to ensure that you are making a margin at that price. So it's something worth bearing in mind, the inflationary numbers and how the macroeconomy might affect you if you're in the retail sector. I don't know what many of you do, so I'm kind of looking at you and hoping that many of you are in fashion or home or something along those lines. Okay, so this is another bigger graph, at least. You can see it easier. It's broken down by different categories, and what this is online share of spend. So you can see by category, eating and drinking. It's lots of kind of samey colors, so apologies for that. But you can see eating and drinking is sort of a turquoise color. But what you can see anyway is that while online as a share of all retail went up significantly during COVID, so it goes back to January 2020 all the way to now, you can see that online clearly made big inroads into to physical spend in that period. Since then, it's dropped back significantly to the point about physical retail over Christmas outperforming online retail. However, it still is higher than it was before because many retailers invested in their transaction and online capability. So M&S, for example, had a website that was a bit of a failure when it first launched, and now it's extremely strong and it drives a lot of sales for them. And that's seen to be the bastion of kind of performance for M&S, or one of the big bastions of performance for M&S. Next have always had a really strong sort of online offer, and they continue to invest in it, and that obviously drives growth for them as well. And an omni-channel offer in general is significantly better because when online's declining, because of the strikes and everything else we saw, the physical stores can then make up for that by growth in their own right. So online and physical is key, and having both is really important because in an increasingly online marketplace where it's more and more crowded with more and more competition, the barriers to entry to creating a website are very small in terms of cost, whereas a physical store, it's there, it's present, footfall goes past it and sees it, and so it builds brand equity. And physical stores building brand equity is a theme I want to come back to and show you some examples of how it actually does that and how it really does generate additional sales for online. So having both is really important. If you're a pure play, then having a physical store, especially because property values are extremely low right now and you can command a very good deal, it's imperative that you look to invest in that if you can. Okay. Again, quite a busy slide, but these are our central projections for a retailer P&L, basically. So obviously this is focused more around a physical store. But what this is showing you is where we were in 2022 with different cost inputs into a P&L. So cost of goods sold is the biggest cost for a retailer, and that's essentially your margin, if you like. So on a gross margin basis, we saw significant declines in 2022 of 7.5% from the majority of retailers. Obviously, this is an average across the sector, so some didn't see this decline. But 7.5%, hit on cost of goods sold is significant, and then it will go up to 4.4%. That's driven by inflation, obviously, and input costs, so raw materials, supply chain labor, and the like, warehousing costs, etc. But again, because of inflation dropping back, we'll start to see by 2025 a reversal in that. But it will still be maintained at quite a high level, so the residual impact will be strong now and into the future. Staffing costs, the minimum wage will go up again in April 2023 by 9.7%. So most retail shop floor employees are on the minimum wage. And so this is very pertinent to you if you're running stores. And also, I'd say that warehouse workers probably get paid a bit more, because they are in short supply at the moment because of unemployment in that sector and everything else. But still, the minimum wage is still relevant in that sector too. And so staff costs going up and up and up, will continue. And it's one thing to bear in mind again if you're a retailer. Utility costs, has been a lot made of this actually in terms of utility costs, but utility costs from a physical store perspective are actually quite small overall. They represent about 1.5% of a fashion retailer's P&L, which is quite small. But for a food retailer that has to refrigerate, heat, lighting, and everything else, it's much bigger. It's more like 3.5% to 4%. And that obviously going up by 110% in 2022 is significant in that sense. And the only reason it didn't go up to 200% is because the government sort of backed retailers with a sort of energy or emergency price gap guarantee. So that helped retailers a lot. It would have been double otherwise. And as you can see, 2023 utility costs will go up again before they start to drop back. but they will be maintained at a higher level than they were before. Even if they drop back by a net 52.5%, they will still actually be higher than before. And then other costs, and you can see business rates. So business rates are a big cost for retailers, and a lot's been made of them over the years, in terms of they're not fit for purpose, they're archaic. I mean, they're all of those things, and the government does need to reform them, but the reality is they're never going to significantly reform business rates because they generate so much for the Treasury, not just from retail, but also from all sorts of other sectors as well, where you have physical offices and all the rest of it. So they're never going to do anything about business rates. And actually, the overall business rates income has risen for the government, or will rise, because of warehouse costs rising. Because more and more retailers invest in warehousing, online pure plays invest in warehousing. Warehouse costs have risen significantly. And so by April, business rates for retailers will drop by 10% on average, but will be significant drops in some locations, making it a lot more affordable to take physical stores in some locations as a result. So I'm going to talk about that a bit later. But first of all, looking at other elements of P&Ls for retailers, on the left is staff costs, essentially. So this is the living wage, national living wage. And what you can see is, since April 2016, it's gone from, quite a low level. I think I can't really read it from here, but like £7.50, let's say, up to now, again, I can't see it properly, but about £10 or thereabouts. And it will go up by 9.7% next year. So that is a significant rise, and one that needs to be budgeted for if you're a retailer. And retailers that are sort of trading at thin margins at the moment will probably need to look at laying off staff, in order to be more efficient within their stores. So we will start to see more unemployment within retail. And on the right, you can see the projections, again from the OBR, that unemployment will start to rise in retail. Well, actually, this is just a national projection, but in retail, particularly, I think it will be higher than this because of the fact that wages have risen so much. And we've started to see, a lot of retailers laying off staff as well. Primark even, got rid of quite a few staff not long ago, and they're doing quite well. But to maintain their gross margins as they sort of want them to be, they basically said to the market, we are going to keep prices constant, and we're going to do that until autumn 2023. So they're essentially seeing a 10% hit on their net margin or gross margin because of inflation. And so to account for that, they needed to think about how they could make those savings. And one of those was in staff costs, unfortunately, for the staff concerned. Okay. So this is just showing you the issues we have at the moment with strikes. We know about the NHS, it's in the press, the Royal Mail, and all these other sort of different businesses, and obviously in retail as well, we've seen some strikes. So what you can see is November 2022, the number of days lost to strike action in the private sector, and you can see that since 96, and even then, it's dwarfing 96 in that sense in terms of number of days lost. So significant issues affecting the economy. And obviously, if you're in, say, the West End of London with all the tube strikes and national rail strikes and everything else, to get to your physical stores, it was hard. If you wanted to shop, you had to really, make a beeline to the store somehow over the Christmas period. So it certainly was an issue for some retailers, at least within the West End. And so, yeah, I mean, this is probably here to stay for a while until we see some reform in the sector and the government sort of making peace with some of these businesses that are, or institutions that are striking. So it will continue into 2023, we would imagine. So other costs that we talked about, or I talked about before, business rates and utilities. So what I wanted to show you here was kind of the balance of power, if you like, in terms of cost, changing from business rates, which on the left, it's a dark blue bar, and then utilities is the light blue bar. So you can see 2021, and this is for a portfolio of shopping centres that we've recently worked on for a client. It's something like 41 shopping centres, so it's actual data from their malls. And what you can see is business rates becoming less and less important as a cost for retailers as they start to drop by 2023. And so by 2025, it's sort of half and half, if you like, between business rates and utilities. So again, if you're a retailer, planning ahead for these costs is important. Okay. So this is, again, like a fairly convoluted slide with a lot of data in it, but it's important in that it represents a retailer where we've got the actual sales data. They're trading in a sort of southeastern, decent-sized town. I can't say who they are for obvious reasons. They're doing 14.7 million sales from their store, so it's a big store. It's an anchor retailer. And what you can see is the effects of everything that I've just talked about on their cost structure now and to 2025. So at the moment, and the way we look at it is how much rent can they afford to pay? So this retailer needs to maintain a 9.5% net margin from their store to return profit to head office. So that's important because of all the costs of head office and online and everything else and the investments. So you can see we've highlighted utilities and business rates in particular. But actually, if you look at the costs, they're going from a situation where they can afford their rent, 1.2% percentage of turnover, but it's 184,000 surplus on affordability. But it goes to a position of minus 200K in 2023. So in other words, they need to go to their landlord and say, look, we can't afford to pay the rent if we want to maintain a decent margin in this location. And that situation will continue not just for 2023, but also 2024 because of cost of goods sold, because of utility costs and everything else I just mentioned. So our business rates, as you can see, will go down. They're actually going to halve for this retailer from 200K to 100K of cost. Other costs will more than sort of make up for that. So business rates are going to help, but they're not going to save some retailers that are sort of on the cusp. So we can see, more store closures going forwards by some of these retailers. If you knew the retailer in question, they are actually closing quite a few stores, but they are opening some too. But you can see by 2025, the situation goes back to where we were in 2022. If you look at the green numbers at the bottom, they're going to again afford to pay the rent. So if you're a property owner or landlord, what does that mean? It means that if you have lease expiries within your portfolio over the next couple of years, you're probably going to see retailers closing stores or looking to renegotiate rents downwards. If you're a retailer, then you need to think about kind of how you can talk to your landlord and work out a way that the landlord can help you over the course of the next 2 years. Is it rent-free? Is it concessions on the rent? What is it? Sort of thing. How can you negotiate that situation? But a lot of landlords did also suffer during COVID. We saw Into, which is one of the biggest owners of shopping centres, completely go into administration, and all their centres got bought back by the banks. And these are big centres. We're talking about the Broadmarsh in Nottingham, the Derby. Well, it's now Westfield, but it was Into, and some other centres across the UK too. So landlords are also feeling the pain. So it's going to be a tough negotiation because they need to make some money back that they lost during COVID as well. So it's an interesting one to watch. So this is what I call the halo effect. I think it's well reported. A lot of people do call it that. What this is the effects of opening a physical store on online retail. So you can see the importance of a physical store, essentially. So this is a fashion brand that has probably about 20 stores in the UK. They're fairly high-end, not luxury, but high-end, I'd say. They opened a store in Southampton. So what you can see here is where it says Q1 2019 at the bottom of the slides. That's when they opened the store. And so the blue line is their online sales before the store opened. And you can see the regional average, which is black, the southeast of England, and also the grey, which is the UK average. So if you follow that line after the store opened, what you can see is it took about a year for the store to mature. And after about a year, we saw a divergence where online sales actually went up. And this is in the catchment area of that location. And it's over and above the southeast average. So this is entirely down to the store. We stripped out every other sort of extraneous variable that could impact on this growth in doing this analysis. And so what we found was that after about a year, and actually, as of now, online sales are up by about 17% on the southeast average. And if you compare that against before, they were 17% lower. So the net halo benefit of this physical store and online sales is plus 35%. And for this retailer, their online sales are worth a lot more than their physical stores. So they see this as being a mechanism for expanding and building the brand and also growing online sales. So the way they value the store is not on the basis of EBITDA alone. Obviously it needs to make money, but they also look at what they call benefit to brand. How does that store benefit the brand, and how much materially does it add to online EBITDA and wholesale EBITDA in this instance as well? And so they look at it across the piece. And this is why the likes of Samsung, Microsoft, Dyson, even Monopoly, with their experiential store on Tottenham Court Road, which is the old Paper Chase store, 10,000 square foot. Why all these wholesalers are looking to take physical stores is they want to sell more products, and they want to do it in a way where they can build brand equity. So that whole Monopoly experience, you can go in and play with your friends, it's like a whole experience. It's designed to sell more Monopoly boards via wholesale. The store loses a lot of money. It's expensive, the rents and everything else. And a lot of retailers lose money in the West End, when they trade. But they're doing it because they want to drive brand equity, and they're doing it so that they can then see positive material gains in online and also wholesale. Happily for this particular retailer, they do well in Southampton from the store, but more importantly, they do well online as well, as you can see. But equally, when you close stores, and this is why I think John Lewis are making a mistake with what they're looking to do around the UK at the moment with some store closures. They've already closed some, the Birmingham one, for example, in Grand Central, which was losing money, to be fair. But even so, they've got Solihull, so they felt that Solihull would make up the difference, from the Birmingham store closing. And it always was a good store for them, Solihull, in the Touchwood scheme. The thing is, with John Lewis, their aspiration is to grow online to about 60% of all store or all business sales by, I think, 2030. But how do they do that if we know stores are so important to online? They're not going to be able to achieve it if they close too many stores. For example, the Newcastle store they've got, if they close that one, they will have nothing in the northeast of England at all from a store perspective. And people don't just shop, online per se. They shop online, but they also go and click and collect from the store itself. So it's really important that they understand that and model that better in-house. So I think they're making a mistake. I don't think they'll get to that online sales aspiration by any means by 2030 if they continue closing stores. So they need to be very careful what they do. Anyway, this is Edinburgh for the same retailer that we worked with. And what happened here is that they closed their store in Edinburgh in Q1 2019. So before that, online sales in the catchment area for this store were 20% higher than the Scottish average. And what we found, again, it took again about a year for the store closure to be felt. But what we saw is that now sales are 3% lower than the Scottish average, as a result online. So the net halo there is a negative 23%, which is significant again. So if you close stores, you lose online sales, and if you open them, you gain online sales, is what the message is here. And this isn't just an isolated example. We've done this kind of analysis for literally 20, 30 retailers in the last couple of years, as they seek to understand better the relationship between different channels. And just to show you that format also matters, I can't again say who the retailer is. It's different to the one on the previous two slides. This is a retailer that has small format stores and large format stores. Again, they're a well-known global fashion retailer. And they have European, you can see obviously European stores here. So the dark blue colors represent the small format stores, and the light blue colors represent the full line stores, where they're bigger, they have more products, a wider range of products, etc. And you can see that the halo effect on online sales for the bigger format stores is significantly higher. It's 15%, a net 30% above the small line stores. The reason for that is because people go into the store, the small format stores, and they think that they're there just selling one type of product. Whereas if you go into the full line stores, the bigger, better frontage, the better visual merchandising, the better staff, you're seeing more of the brand and you're conveying more of the brand, and therefore online sales benefit from that as well. And people realize that this particular retailer sells more than just one product, which, they sell a lot more than that. So I can't say who it is, otherwise it'll give it away. Okay, getting into some pictures just to brighten things up, considering the dry nature of some of the tables and charts I've been showing before. Here's Oxford Street as it stands right now. I mean, it's not obviously the best set of pictures for Oxford Street, but you can see that Oxford Street has really declined over the last few years. And if you look at rents, which are a barometer of performance in a sense, it went from, I think, £1,000 zone A, which is essentially how surveyors measure rent in a store. It's the first sort of X amount of space into the store based on the frontage. It went from that to about, let's say, £700 a foot now. So that's about a 30% decline in rent per square foot. And what we've seen is that many retailers are not making that much money on Oxford Street. And we've started to see landlords, therefore, let their properties out to candy shops. And the whole thing is kind of a tax avoidance thing, really. There's a potential for it to be money laundering as well, because there's no prices in the stores. But that's another question. But what Westminster Council are doing is trying to go after these candy stores for business rates, because they're not paying the business rates. And what happens is they go after the company, they then close the company or put it into administration, and then they assign the lease to a completely new shell company, and it goes on and on and on. And we've got now 40 candy stores in Oxford Street, which, who shops there? Who knows? But what it's doing is it's giving the landlord a rent, and it's giving the landlord the ability to avoid empty rates tax, because if the shop's empty for more than a year, they have to pay the full business rates to the council, which is a lot in Oxford Street, as you can imagine. So it's a problem, and one that hopefully will change. But at the moment, there's nothing that can be done about it. We are starting to see more of a crackdown, but because these companies keep on moving, it's hard. But we will see Oxford Street starting to improve, I think. Part of that is because of business rates again. So I know I've been talking about business rates a lot, but it's one of sort of my pet topics in a way. And I think it's useful because it gives you an idea as to what's going on or what will go on in the high street going forwards. So what this is showing on the right is a table showing the business rates benefits for certain size retailers. The bigger the store, the more benefit you're going to get. So in the case of 100K stores, I mean, this is obviously big grocers, some of the big bulky home and electrical goods retailers, they're going to see business rates dropping by about 34%, whereas the smaller stores are going to see far less of a drop, as you can see. But on the left, if you look at it by type of centre, what you can see is the out-of-town malls, the major high streets and city centres, town centres, will see significantly lower business rates going forwards, making them more competitive for a retailer to trade in those locations. What you can equally see is small local high streets, and I found this interesting because during COVID, people went back to their local high streets to shop, buying grocery products from independent retailers, buying all sorts of products, from florists, etc. They were shopping locally because they were less mobile. But now that people are going back into the office, a few days a week, if not more, we're starting to see those retailers declining. And actually, the biggest set of administrations over the next year will probably be in the independent sector because their rents have risen because they were doing better, these locations were doing better in general. And business rates are reflecting that. As you can see, in small local high streets, which is just left of the orange bar, you can see actually a rateable value increase. So these independent retailers are going to face a double whammy of reduced demand, rising costs, and also more business rates to pay as well. So independents are going to be hit quite hard. I don't see any major multiple retailers struggling over the next year or so. Maybe Matalan and Wilko will have to close some stores. Wilko, they received funding from Hilco, and they will probably need to close stores on the back of that funding as a result of having to pay back. And Matalan recently sort of got some of their debt facility removed, through obviously increased investment. But again, they're going to have to close stores because of that. But those are the two that I see will struggle, but not necessarily have to close wholesale. But it's the independent sector that will be the issue here. So going forward, looking at business rates in more detail, this is our list of the top 20 centres in the UK by basically retail spend coming to them. So you can see London, West End, Birmingham, Manchester. It excludes Scotland because Scotland didn't publish business rates at the time that we did this. Their data wasn't available. So there's no Glasgow and Edinburgh here, before any of you sort of mention it. But you can see that London's West End will see a 20% decline in rateable value for shops, Birmingham 27%, and Leeds 30%. So you can see that these locations are going to become stronger and more attractive from a retailer expansion perspective because their business rates are dropping so much. And business rates are very high in some of these kind of prime locations like Leeds, Trinity, for example, or Birmingham, Bullring. If you look at malls, these are shopping malls that will see some really big, Westfield Stratford is an exception, partly because of the F&B that drives it, and the rents actually went up in F&B. But what you can see here is that for the most part, even Mary Hill, and I'm actually doing a bit of work in Mary Hill at the moment, they are seeing significant declines in business rates. And again, that will make these out-of-town malls more attractive. So Reserved, for example, the sort of CE fashion retail I mentioned, they are looking at out-of-town malls as a way of expanding. They're going into the Westfields and the Trafford Centre, so 3 malls that are seeing significant declines in business rates. And this map is showing you kind of the data that goes into all of this. So each blob represents a store, basically. So you can see the bigger the blob, the bigger the store. And so this axis, I'm going to have to go over here. This axis here, this green sort of axis there, is Oxford Street. And then you can see going down Regent Street and Bond Street as well. But what we've seen is retailers moving away from Oxford Street, especially the sort of more niche fashion brands, the kind of cooler, more urban fashion brands, and they're looking more at places like Soho. So you can see Beak Street and Brewer Street. They've seen rental increases and therefore business rates increases because business rates follow rents. It's a big lagging indicator, in the sense that the last revaluation was 2017, but there is going to be more of a sort of cycle now where we see revaluations every couple of years. So anyway, Soho and also Mayfair will see rateable value increases, so business rates will go up there, whereas Oxford Street, Regent Street, Bond Street will be far more attractive in a sense because their business rates are coming down. So you can see each retailer there in the West End. And in Manchester, you can see that kind of move towards the northern quarter. So on the east side of Manchester, more and more retailers are looking at the northern quarter as a place to expand into. And you can see that through the colors there. So the traditional areas around Arndale, King Street, etc., have seen declines in business rates because rents have declined in those places, as more and more retailers want to be in the cooler areas, like the northern quarter. So it's a bit like the Soho, essentially, of Manchester. So it's interesting to see kind of how our geographies, our high streets are changing, and where is desired for retailers going forwards. I thought these are sort of general topics now that are happening in retail that will continue before we get into sort of more of a Q&A. So first of all, Frasers Group. These are all the brands they have now on the left, so you can see. They bought, I think, a number of brands from JD Sports as well that they owned, like Scott's and a few others. But you can see Frasers Group have House of Fraser, Frasers, Tessuti, Sports Direct. You know, there's loads and loads of brands there. They can create, and in fact, they are creating their own department stores in Frasers, mainly focused on fashion and beauty. But you know, they've got so many brands, including online brands, Misguided, I Saw It First, Amara, Studio. So they are carving up the sector, in a sense, between them, Frasers and Next. On the right, you've got Victoria's Secret, which is obviously the UK franchise, not the entire business. Lipsy, Gap, you know, the Gap brand, Made.com, which they bought for nothing. So you can sort of see what's happening here in the sector. Consolidation, you know, JD want to expand, but they want to expand differently. JD have come out and said that they want to focus on their core JD brand, which is why they offloaded those brands to Frasers Group, and they want to expand internationally as well. So they're the third, if you like, and then Primark are the other. And again, Primark are ones that will focus purely on their own brand and their physical store network. It's worth mentioning this because I think people undervalue the value of marginalized groups, and it's just putting this into numbers a little bit. So we've got the disabled community. You know, they represent 14.1 million people in the UK, according to Scope. But many physical stores and locations in general just do not have the capacity to deal with them. And we're talking about sort of people that are mentally disabled as well as physically here in this instance. So spending power off that group is 274 billion. Obviously not all in retail, but you know, a lot of it will be in retail. And a lot of these people are forced to buy online as a result of the incapacity of physical stores to deal with them. So it's certainly an area that I think, from an ESG perspective, more and more businesses are investing in. And it's really important because you can tap into, you know, significant money, as you can see here, if you invest in some of these groups. Older people, you know, 12.4 million people aged 65 plus in the UK, 320 billion spending power, according to Saga data. So again, it's significant in terms of, you know, the grey pound, if you want to call it that. It's worth investing in older people, and you know, and that if you're in fashion as well, you know, your ranges and your products, you know, generally need to sort of take that into account. You've got sort of the LGBT community as well, and 70 to 80 billion worth of spending power according to Stonewall. 4.2 million people identified as within that group, and then finally, kind of ethnic minority populations as well. You know, 174 billion worth of spend from 8.9 million people. So these are groups that are under-invested in from a marketing perspective, from a sort of advertising perspective, if you like, and also product perspective too, given the nature of products that are being developed in general tends to be for kind of this, you know, the core product, core sort of population in the UK. But these groups are rising in sort of numbers and also in terms of spend, so it's worth investing in. A lot of focus is on millennials. And millennials, you know, obviously can drive, Gen Z, they can obviously drive spend, but the spending power of the over 65s is significantly higher because they have, you know, often paid off their mortgages, they have significant disposable income, a lot of them. So it's worth, again, thinking about that more overtly. The final sort of set of slides, this one is looking at the metaverse, just to show that it's kind of a mess. On the right here, what you can see is different brands that have invested in the metaverse. So from Adidas and Prada down to Zara. But the commonality between them is there is no commonality. You know, they've invested in Decentraland, Meta, which is the Facebook portal, Roblox, you know, different types of metaverses exist. On the left is our sort of viewpoint on the different metaverses that there are. There's gaming, you know, from Minecraft to even Grand Theft Auto, you know, and Roblox. So there's a mix of sort of, you know, metaverses, if you like, in the gaming sector, where people can buy virtual products for their avatars in that sense, or their gaming characters. And then you can see Decentraland, which is obviously quite popular, and people are buying plots of land, and also landlords, property owners are buying investing in shopping centres virtually there. But they've, a lot of the time, especially with the crash in Bitcoin and everything else, they've lost a lot of money in doing so. And the actual numbers of people that are actually going onto the metaverse that have the VR headsets and capability to do so is actually declining. So will it be a success? I mean, it may well be in the future if tech improves to the point where it's something that people do more and more. But I think, at the moment, a lot of these investments that Gucci and others have made, they're yet to pay off in terms of any material gain for them. So while it's interesting to bear in mind the metaverse, it's something that I think has seen a lot of collar inches, but isn't necessarily there yet. It may not well be there for another 4 or 5 years. Obviously, some of you may disagree, and it'd be good to hear from you on that front. The final thing I wanted to show before we get into Q&A, and again, I'm not sure how much time we've got, is the evolution of retail venues. And that is high streets, shopping malls, retail parks. I'm working a lot in this area because I work with a lot of property investors and retailers, and some of them actually are wellness hubs, health and wellness hubs. So bringing in medical, bringing in optometry, dentistry, bringing in spas, products, medical tech into the high streets, because the NHS is under immense pressure, and having the ability to sort of go elsewhere. More and more people, even with low disposable incomes, are going private for various, consultations these days, because they just can't get an appointment in the NHS. And so having this within shopping malls, and you will start to see this, was one opening in Westfield, London, which is going to be about 11,000 square feet. They're investing in a 50,000 square foot wellness hub to take over kind of the upper end of the village, which is the luxury area. And that's going to be all about medical, health, wellness, MRI scanners, X-rays, pharmacies, and all the rest of it. So you're going to be able to go there, if you work there, live there, etc. And we'll see more and more of these things in big malls, big high streets across the UK. Food halls, we've seen the increase in box park type food halls, but also food halls in general come into malls and also high streets as well. We're going to see a lot more food halls come about, so food trucks and that sort of thing, because it's about sort of, I guess, the experience of food, coming to an area where you can also go to music venues, go to bars, and also eat your food at the same time and socialize. So, it's a different concept to just a restaurant or a traditional sort of takeaway type thing. Child play concepts, there's Funbox, which is expanding across the UK. They provide duck pin bowling, they provide mini golf and arcade machines. And to give you an example, the Debenhams in Wandsworth, if you're familiar with that location, the entirety of it's been turned into something called Gravity, which is 80,000 square feet. And it's basically mini golf, it's go-karting, it's a whole hub for entertainment. And other entertainment operators have come on the back of it, like Boom Battle Bar and others. So we're starting to see a transformation of old department store spaces into medical, into leisure, into entertainment, into F&B. And, the arcade element of it, I've seen kids literally as much as like 8 years old going and putting £100 on their cards to spend on the arcades. So there's money to be had in it if you're in that sector. And then the other things here, you can see here on the bottom, tuition centres. We're starting to see an increase in other forms of non-retail. And because of that retail space, we have too much space in the UK. We're starting to move to a situation where we might get back to equilibrium, where demand and supply are equal to each other, because a lot of that retail space that is now redundant is being turned into something else. And more of a sort of community hub is what I think a lot of landlords are going for. And I think they're achieving that. Some of these places, Wandsworth is now a hub for people from Clapham to go to other places around London. So it's actually succeeded in that sense. I think with that, I'm going to move into Q&A, depending on how much time I've got. So please do feel free to ask any questions you might like. Okay, if there's no questions, which is fine, yeah, it's absolutely fine, then thank you for your time. Really good to see you all, and it's a really good turnout as well. And enjoy the rest of the event today and however long you're here for. And feel free, to contact me. It's jonathan@jdmretail.com if you want to ask any questions after the event or know more about what we do, or via, the Hive group as well. So thank you very much, and have a great rest of the day.